We've had some economic reports from the UK and the US today, which has had quite an impact on the pound-dollar currency pair. And there's two reports in particular that I think have really grabbed traders' attention and contributed to the moves that we have seen. The first of that this morning came from the UK, the Consumer Price Index, the inflation data that we do get for the UK, and the most widely followed piece of inflation data at that. It is released alongside things like the PPI, the RPI, but it's the CPI that the traders are most interested in. And the reason for that is that's because the data that the central bank is most interested in. And it was a little bit disappointing today. I know it looks like a sea of green, but which ordinarily can be viewed as a positive thing, but in this case, it isn't. The Bank of England, like the rest of us, want to see inflation coming back down towards 2%. And it seems that kind of stalled last month. Now, there has been a lot of negative attention around this, and to be honest, I'm just not really on board with that. Yes, the 0.4% monthly reading was comfortably above the 0.2%, but from an annual basis, 5.1 to 4.9 isn't really that significant, and 4 to 3.8 isn't that significant either. Basically, we were looking at marginal changes this month, and that's exactly what we got, even if it was slightly in the wrong direction. I don't feel like this was ever going to be a game changer month from the UK inflation standpoint, and I still don't think that is the case. It is expected to still fall towards the back end of Q1, which should create a very different picture for the Bank of England going into the second quarter of this year, and in particular that May meeting when we'll get new economic forecasts. But as far as December and even January next month's data is concerned, we're probably not going to see an enormous amount of progress, and we've seen that evident in the December figures this morning. The other key report from the US was the retail sales figures, and again, they were really interesting, but from a far more positive perspective. The US economy has managed to achieve something which others haven't. While the euro area looks as though it's seeing inflation fall back towards its 2% goal, and the UK should see a lot more progress on that, for example, over the coming months. They've both done so at the expense of the economy. The Eurozone may already be in recession, and the UK may also be in recession, but probably not. But either way, we're both looking at a case of the economy flatlining, as it has for the majority of 2023, and as it's expected to do for the majority of 2024. Whereas the US, on the other hand, has managed to maintain a solid economic performance despite interest rates rising above 5%. The labour market isn't red hot anymore, but it is still very warm. And yet inflation is rapidly falling back towards its 2% target, which means we could get a rate cut from the Fed as early as March, even if it's not necessarily willing to accept that at this point. And that stronger economic performance is evident in the retail sales numbers. You can see here 0.6% on the monthly basis, easily beating the reading of 0.4%. The control group as well, 0.8%, was an improvement last month on 0.5%. So clearly the consumer is still quite strong in the US, and that's partly down to the fact that unemployment is low, and also partly down to the fact that the economy is continuing to perform quite well. We've seen excess savings have been largely run down in the US, so we can't really attribute it to that significantly anymore. But ultimately, what this all points to is the Fed may well and now looks well on course to achieve its goal of getting inflation back to target while managing a stable economy. The soft landing that at one stage looked extremely difficult to attain looks as though it's now within reach. So in light of this information, let's take a look at the charts and see what that ultimately means. So as I mentioned, this is the pound against the US dollar, and there's a few important things to point out here. One is that we had what looked like a rising triangle, which under ordinary circumstances could potentially be a bullish signal, but it wasn't really acting in that way. 128 was continuing to provide an area of significant resistance. You can see that from the black line where the price kept running into. We were seeing lagging momentum for quite a while, for a number of weeks going into the end of 2024. And you can see that on the stochastic and the MACD at the bottom of the screen. But we weren't necessarily seeing a breakout, and the price was starting to become incredibly squeezed. The breakout finally came yesterday, and rather than to the upside, it came to the downside. The break of that rising trend line, potentially signaling that we'd seen a bearish move in this currency pair after such a long period of consolidation. Now, if we look down at the 4-hour chart, then that picture starts to look a lot more significant, because now you can see that over the course of the last few weeks, over the course of the last month, we've actually seen a triple top form. You can see the first top actually appear here back in the middle of December, the second top forming around the end of December, and the third top appearing around the 12th of January. So quite evenly spaced out. The neckline coming in there around 126, 126.10. Now, we haven't seen a break of that at this stage, but it's not looking great. If you can see that we've seen the break of the rising trend line, and I know there's a lot on this chart, so it looks a little bit messy, but the break of the rising trend line that we saw yesterday, we also followed that with a break of the 200, 233 period simple moving average on the 4-hour chart too. We ran into some support around that 126.10 again. That's the neckline of that triple top we've just discussed before a brief corrective move. Now, we've seen a lot of choppy trading today because there has been a lot of economic data, the two of which we've already pointed out. But I think the key thing for me now is going to be how this performs around those fib retracement levels, because that could signal to us whether we are seeing a corrective move over the course of today or not. And you can see that 50 fib around 126.90, close to 127, is actually the point where the price started to rotate. So that's potentially another bearish confirmation signal. We didn't see a retest of the rising trend line, but we did see a relatively decent retest of the 200, 233 period simple moving average. So combine the two things together, now a rotation off the fib level, and that 126.10, 126 area starts to look incredibly important. A break of that 126 could be the breakout, which sees this move accelerate to the downside, just as we saw yesterday following the break of the rising trend line. And the good thing about double tops and triple tops and head and shoulders patterns is, theoretically at least, it gives us an idea of the potential projection that we could be looking at for the price because of the size of the formation. So it's going to be really interesting to see if we do see a break of that 126, whether we do get that accelerated move to the downside.